Lemonade is a name that we've been talking about for a long time here at Rebellionaire. The stock is finally up about 50% or so after the company reported earnings last week. So in this video, we're going to talk about why we think this might just be the beginning for Lemonade rather than just a full vindication of what we've been saying all along. So we have been talking about Lemonade for a long time. We put out a video earlier this year coming up with an $82 valuation for Lemonade. I think at the time the stock was trading in the teens or so. After the 50% run up that the stock had in the past week, it's trading at around $27 right now. We might feel vindicated with where we are, but actually I think that the upside has actually grown a little bit from where we said it was before. So we're going to talk about why that is in this video. We're going to do a very nerdy deep dive on some of the numbers, which I think you just have to do. This is an insurance company at the end of the day, so you have to be comfortable talking about numbers. So we're going to get into that and give an updated valuation with the things that we've learned on the Q3 earnings call that just happened. Okay, so we listened to a lot of the bears in this space, actually. A lot of the bears point out things like the fact that the company's earnings are consistently negative, and that leads to declining book equity or book value per share. Why is that important? Because as an insurance company, you need to have a strong capital base in order to be able to provide healthy coverage for your growing base of customers. So if your book value, your book equity is actually shrinking, it implies that you don't have the capital resources to actually grow your book of business. And Lemonade is very much a growth story. So that's a legitimately concerning trend if you just take that at face value. So let's take a look at Lemonade's historical financial performance to put in context some of what the bears have been saying. So here I'm going to share this, and you can see the blue line is their adjusted EBITDA and the orange line is their net income. So, net income negative, that leads to the declining book equity, book value that the bears are so fond of talking about. And frankly, if you look at these numbers, it's like, okay, maybe a slight trend up, but in the last year or so, very much down. So not a very compelling growth story either. It's like, okay, they're growing top line, but bottom line is actually shrinking at an accelerated rate. So what's so exciting about this story? And frankly, all the bears that I listen to, this is all they talk about. It's like, oh, number go down, stock bad, like not enough capital. Not to say that these are not important metrics. We very much believe they are. But what's important as an investor is not what have they done historically, but it's where are they going in the future. I want to lay the case that these numbers are going to accelerate very rapidly and go positive in a way that very few people are thinking is even possible right now. So why is this the case? Well, the company is acquiring customers at very attractive economics. The company about a year ago launched what they call their synthetic agents program. And this is essentially a financing mechanism to really accelerate the growth spend that the company is engaging in so that they can acquire more customers at a more rapid rate. Daniel Schreiber, the CEO, noted that the customer lifetime value is the total premium that you're bringing in over the expected life of a customer, minus any claims that you're expecting to pay out and any other kind of servicing expenses that go along with that. And then you take that stream of cash flows and you discount it to the present. And then you look at that in relationship to the customer acquisition cost. So what does it take you to acquire that customer? If you were spending $200 to acquire a customer that only had a lifetime value of $100, for example, that would obviously be very stupid. But what they noted in this blog is that the lifetime value divided by the CAC of the customer, so LTV to CAC is the name of that ratio, that gives an indication of a 3-to-1 ratio. So in other words, if you're spending $200 to acquire a customer, but you're getting $600 on a present value basis in return for that. So super attractive economics. And then that translates to about a 50% IRR. So you could imagine as you're an investor, and you can invest in something that has a 50% IRR, you want to kind of spend as much on that as possible because that's going to generate really attractive returns for you. And so that's what Lemonade is actually seeing in their book of business. They're able to acquire customers at extremely attractive economics. And so it really makes sense for them to accelerate that spend. So that's what the synthetic agents program allows them to do. Because Lemonade is an insurance company and they do have these very real capital constraints that the bears are right in pointing out. They actually need some assistance to really accelerate their growth in a way that doesn't really impact their balance sheet. So there's a company called General Catalyst that is actually their program on this synthetic agents partnership. And essentially they are covering 80% of the cost to acquire a new customer. This is very important because this is not a recourse loan or a traditional loan that a company might get from a bank, because General Catalyst is actually participating in the downside risk, should there be any, with the customers that they're essentially underwriting or loaning against. that means that Lemonade's balance sheet is more freed up to continue to grow and to add to their in-force premium. So when you think about a 50% IRR, and then you essentially lever it on top of that. So you say, all right, I'm going to only cover 20% of the cost of this, then I'm going to use like a debt-like instrument in order to really lever up my returns. The returns you get on something like that are actually pretty wild. So if these numbers are accurate, it implies that the company is going to be having pretty wild returns as these highly valuable customers eventually can contribute to the bottom line. In fact, they already are contributing to the bottom line. You have to know where to look, which we'll get into in a minute. So we actually wanted to understand this for ourselves. We don't want to take management's word for it on anything. We want to do our own due diligence. So we actually reached out to General Catalyst. Pranav Singhvi is a managing partner at General Catalyst who runs their customer value fund, which is the part of General Catalyst that actually provides these customer acquisition financing arrangements, not only to Lemonade, but to a lot of other companies. So we wanted to understand the program from his point of view and just make sure that it kind of made sense and that we were thinking about it right. So this is a big part of what we do here at Rebellionaire. We dive deep. We're having conversations that we don't think a lot of people have. But this is something we put out a while ago, didn't get very many views, but I think it was extremely useful. So I want to share a clip from that conversation with Pranav Singhvi from General Catalyst. And as a reminder, we're going to be talking a lot about customer acquisition cost, which is how much does it cost to acquire those customers, your marketing spend. And Pranav is going to talk about that as CAC because that's the acronym. So without further ado, here's Pranav from General Catalyst.
To your point, they have a part of their business that is, in a sense, coin operated. They spend $1 in sales and marketing, and that generates an ROI in excess of $1 over some period of time. And there's quite a bit of structure associated with that. And that's sort of what we call the CAC machine, if you will, sort of the customer acquisition machine for the business. And then there's a second part of the business that effectively takes the residual lifetime value left over from the investment in customer acquisition cost and funds the rest of the OpEx of the company, which is your investment in product, engineering, operations, anything else that you may be investing in. You can almost think of this as the operating company that enables the company to have its CAC machine scale. And so the residual lifetime value from the first sub company, the CAC machine, funds the non-S&M OpEx, so the non-CAC OpEx of the second company, in addition to any excess cash the company has on its balance sheet, if you will. And so when you model the business this way, to your point, the ROI on sales and marketing is what's actually funding the investment on the operating company. And keep in mind, the operating company is very important because the operating company is what gives the company the ability to have sort of the long-term investment in sales and marketing and scale it over time. But the actual investment in sales and marketing is extremely positive ROI that effectively subsidizes the longer-term investments that you make in product engineering that may not have a near-term clear ROI, but are important and critical for the long-term value of the company, if you will. So we really model these businesses as these two separate businesses. Now, historically, it's all been lumped together and it's all largely been equity finance with maybe a little bit of corporate debt. And every now and then someone gets like a line of credit that they never use, that kind of thing. Nobody's actually double clicked into making these sort of businesses much more higher resolution in parts of how much risk that they own. So what I mean when I say that is the CAC machine that I just alluded to is largely de-risked. If you isolate that part of the business, it ought to actually have quite a bit of leverage in it and in the way it can be financed. But unfortunately, historically, everything's just been a singular product to fund all these businesses. And so that's sort of how we think about these companies. And in a sense, when you start thinking of the world this way, something interesting happens. Which is when you sort of remove the CAC machine, or effectively the investment in sales and marketing and the ROI on sales and marketing from a company's P&L, you almost treat it as an asset that can be taken off balance sheet. These companies are highly cash generative in nature. It's almost like, we internally think about these businesses not in the context of EBITDA, but actually EBIT CAC, which is if you remove CAC from sort of the earnings of these businesses, are they cash generative in nature? Because that's really the fundamental profitability metric for lots of these companies, because CAC is a discretionary decision they're making to invest for a higher ROI, which on a GAAP P&L statement ends up looking like a making the company look unprofitable when in reality it's an investment that they're making that will generate a good ROI.
So I found that to be an extremely eye-opening conversation. You look at a traditional company, and EBITDA is the thing that we're all, as financial analysts, used to thinking about. EBITDA and net income, like you want to look at those kind of core metrics. And as we showed earlier, pull this back up. So what we did is we took the company's historical financials and we took the net income, we added back interest, taxes, and instead of depreciation and amortization to get to EBITDA, we added back the customer acquisition cost to get to EBIT CAC. There are a few very small estimates that we had to include in here because the company did not historically include outright growth spend until a couple quarters ago. So we made some very minor estimates for some of this, but I think it doesn't change the story at all. And this is the story that you see when you look at the company on an EBIT CAC basis. So all of a sudden, instead of slightly increasing and then going back down, when you strip out the customer acquisition cost, the trend is actually very clear. So the core profitability of the company, which is what this is, if you strip out what are you spending to really grow your business, is improving at a very easy to visualize rate. And keep in mind that like the difference between this line and this line is how much are you spending on those highly valuable customers that we were talking about earlier. So you're really ramping up spend on highly valuable customers. And that's the reason that these kind of core metrics, book equity, net income, and adjusted EBITDA are looking so mediocre as they are today. I want to talk about where is the company going. The company has been talking a lot about car right now. This is their next area of focus from a growth perspective. And the company acquired Metromile a couple of years ago, and frankly, it looks like a bit of a failed acquisition. The in-force premium from that has gone down a bit. They've churned customers. The loss ratios were never really where they wanted them to be. Now I think they're actually around 92%, if my memory is right, in Q3. It would have been 82% if it were not for some one-time items. So all of a sudden, you're getting some pretty attractive customer economics where you're turning the corner, where if you're doing that same lifetime value calculation on the car piece of the business, that lifetime value used to be negative. If you're paying out more in claims than you're receiving in premium, you don't want to grow that business. You want to figure out that piece of it first. And then once you got a handle on that, then you can grow that business. So that's what the company has spent the last 2 years doing, is getting the pricing right, getting the underwriting right. And frankly, there was a bit of delay from the inflation that happened with COVID. And a lot of the claims that they were seeing were much higher than they were initially expecting because of inflation. But the regulatory environment, especially in California, was not allowing them to pass those rate increases on to customers. They were just waiting an absurd amount of time before they were allowing those rate increases to move on. So we're now at this point where they're past all that, and the loss ratios are very close to where they want them to be in the long run, with a credible path to continue to improve. And so now it makes sense to really ramp up the growth on car. 2 years ago, Lemonade had an investor day where they talked about the car business. And what they said at that time was that they had a wait list of 300,000 customers, essentially people who, like myself, are wanting to join Lemonade Car and get car insurance, but the product is just not offered yet in their geography. There's a weird glare in my eye. Sorry about that. Morning sun coming in. Lemonade does have these regulatory approvals. They've got licenses in all 50 states, but they wanted to really make sure that the economics are sound before they go out and really increase their book of business in those geographies. So now we're at this point. The company's talking about how they're going to really accelerate car in 2025. And I think that has some really interesting implications. So that wait list of 300,000 customers, it seems reasonable to me to presume that has grown over the last 2 years since they disclosed that figure. But even if we just assume that is the right figure and only 10% of those customers opt to actually purchase a policy at an average premium per customer of over $1,750, which is what they disclosed in Q3, that would imply $52 million of new premium that the company could basically just get with a snap of the fingers by sending an email out to people on the wait list. That's a very significant amount of growth for the company, and frankly comparable to what they would do on their own, but they'd have to pay for it pretty significantly in marketing spend. So with zero marketing spend or very limited marketing spend, they can significantly grow their book of business. Very reasonable, I think, to assume that they could actually get more than 10% of those customers. So the upside here is actually pretty significant. So you've got this major cross-selling opportunity, which has been a big piece of the bull case for a while, but has never really materialized. I think we're now at the point where this cross-selling opportunity is going to start kicking in. So if you play the story forward a little bit, you're going to continue your plan A, which is spending a lot of money on acquiring customers that have a very nice lifetime value, LTV to CAC ratio of around 3, very high IRRs, and you're funding that with synthetic agents. You're going to keep doing that. But then on top of that, which was already a really good story, that was our base case in the $82 valuation we shared earlier this year, you're going to pick up for free, essentially, a very nice book of business of new car customers from your existing customer base. And you're going to do that with no cost. So all of a sudden, your loss ratios, like all your revenue is going to increase at an accelerating rate beyond what the company had already been doing. So when we went back to our model and basically said, okay, let's look at what this looks like if we actually give the company credit for cross-selling car, and basically what would it take for the company to get to adjusted EBITDA positive in 2026, which was earlier than our model suggested that they would be. And frankly, like, we had to revise things upwards a lot more than we thought we would have had to in order to show what management is essentially guided for on this latest call. So let's look back at the model now and show what this looks like with management's number, or basically making the numbers look like what management guided for. So here we are in Q4 2024 right now. It's going to be negative again on EBIT, CAC, adjusted EBITDA, and net income. But what you can see is the leading indicator is going to cross into positive territory in 2025. And then in 2026, you're going to get adjusted EBITDA positive and net income positive. This is an acceleration from what we were expecting. But I think the real story has always been in the out years. So once you cross the profitability, it's not like we made it and then you've got 10 cents of earnings in the first quarter that you do that. That's not the story. The story is, what does this company look like in 2030 or in 2040 even? We're not underwriting it for 2040, but we think it's very credible that they continued this flywheel of acquiring new customers at great economics and leveraging their extremely efficient fixed cost base in order to essentially make all the growth that they're having and all this gross margin that they're going to be generating, have that flow to the bottom line. And what you can see is you go from losing like 50-ish million on adjusted EBITDA or net income today to like hundreds of millions of dollars on net income and adjusted EBITDA per quarter. These are not annual figures. This is quarterly by the end of the decade. And this is the story that I think is so underrated. We're looking at a scenario where Lemonade is generating in excess of $4, $5 in earnings per share per year by the end of the decade. And so if you put whatever reasonable multiple you want on top of that, you get to very significant upside. So let's take a look now over at our actual model. This is just the summary, because I know most of you aren't finance nerds and numbers nerds like I am. It's a little easier to see things visually. But when we ran to our own discounted cash flow and looked at what do these numbers look like if you actually give them credit for cross-selling, well, our $82 valuation now looks like $116. Again, this is not a future price target. This is a present value. So the stock that, even though it's up 50% to $27 right now, we're saying it still has like a 4x to go on a present value basis. So this is the reason we're so bullish on the company. I am reminded, and somebody reminded me recently of the quote, I'm going to paraphrase, that all models are wrong, but some are useful. I think that's definitely the case with this one. These numbers will absolutely be wrong. Are these trends the right trends? Is the company going to continue to acquire customers with these phenomenal economics? Are they going to be successful in cross-selling their auto business to their existing policyholders? And are they going to be able to continue to grow the business with the fixed cost base that they have so far to date? We think the answer to all these questions is yes. Whether the ramp of the trajectory overshot or undershot a little bit doesn't really matter when the magnitude of the valuation difference is as stark as it is to where the stock is actually trading today. So risks, I do want to make sure we're being reasonable about this. This is an insurance company, so if there is a kind of once in a century or probably even longer catastrophic storm or something like that, that can definitely hurt the company's balance sheet and ability to grow, and potentially could cause the company to go bankrupt. While the company is cash flow positive today, and we think bankruptcy risk is very small, as with any insurance company, you could have some freak event that is so big that it does wipe out the company. So that is a very real risk. though it's one that we think is a very low likelihood. And then kind of continuing to grow their capital base. So this is something that the bears are so focused on. If they're right, if book value continues shrinking beyond the point where we think it will, and they can't make that flip to growing it, then that would actually be a real big problem for Lemonade. We think it's important to understand those points and to model them out, but not to only focus on them. We want to look at where they're going. We think that where the company is going is a very good story. But this is a story that we think is so misunderstood. So many people come to us and say, like, why are you guys talking about Lemonade? That stock hasn't done anything in like 5 years, and like look at the stock price or look at the stock chart. It just looks bad. It looks like one of these trash SPAC companies that is going to eventually go down to zero. We think that is not the case at all. It's just a fundamentally misunderstood company where if you really take the time to look under the hood, to actually talk to their partners like we did in this video, you'll see that what they're building is extremely exciting, and where the company is going is, we think, a lot higher from here. Not investment advice. While we are bullish on the share price and the price target, we are not your financial advisors. We are financial advisors. So if you do want to hear a little bit more about what we do, you can check us out at rebellionaire.com. Just wanted to share these thoughts and why, even after the 50% run up, we don't think the company is overvalued. Very excited to be a long-term shareholder in this company. Lemonade has an investor day later this month in November of 2024. We're going to be attending that, and we'll share another video with what we learned at that. And with that, I'll say bye for now.